Why investing in ETFs is going to make you rich. Who wouldn't want to save $1 million? The perfect platform for this kind of simplified investing that can make you millions of dollars is ETFs. Finding the correct ETFs and making regular contributions will allow you to retire with $1 to $2 million or more. Compound interest is your friend when it comes to ETF investing. In this video, we'll see how ETFs can make you rich and what the best strategy is for ETF investing. But before that, like and share the video, subscribe to the channel, and turn the bell icon on. How do ETFs make you rich? You can get rich quickly by investing in exchange-traded funds and reinvesting your dividends and capital gains. The longer and more reliably you invest, the more your portfolio is likely to increase in value. When it comes to your portfolio, consistency is crucial. Your portfolio's growth will be proportional to the amount of money you can invest. Building wealth is easier if you start investing at a young age and keep making regular investments. A $100,000 investment yielding an 8% return would be worth $993,000. If you start with $100,000 and add $5,000 per year, you have $1.464 million after 30 years. As time goes on, the prices of the individual equities that make up the ETF's holding will rise. The primary way to generate money with ETFs is through capital gains, which are simply price increases. A dividend is a cash payment that is distributed to shareholders of certain stocks. You can multiply the return on your dividend investment by reinvesting the money you receive. The idea of compound interest is that your money starts making money. The annual return on a $100,000 portfolio is $10,000. However, a portfolio worth $1 million that earns 10% annually earns $100,000. You will have $1.1 million to work with the following year and will make $110,000 at a 10% rate. The issue is that it takes a lot of savings to reach your first $100,000. If you invest $10,000, you will only make $1,000 a year. Therefore, investing becomes simpler the more money you have to put into it. Why choose ETFs over others? Diversification. ETFs typically hold a basket of various assets, such as stocks, bonds, commodities, or real estate. By investing in one ETF, you gain exposure to a wide range of underlying assets, spreading the risk across different industries and companies. Diversification helps reduce the impact of any single investment's poor performance on your overall portfolio. Lower costs. ETFs are known for their relatively low expense ratios compared to actively managed funds. Lower cost means more of your investment returns stay in your pocket, potentially increasing your wealth over time. Liquidity. ETFs trade on stock exchanges like individual stocks, which means they are generally more liquid than mutual funds. This liquidity provides flexibility in buying and selling ETF shares at any time during market hours, which can be beneficial for managing your investment portfolio. Passive management. Many ETFs are passively managed, meaning they aim to replicate the performance of a specific index or asset class. By avoiding the need for active fund management, ETFs typically have lower management fees and potentially reduced tax implications. Performance potential. While there are no guarantees of high returns, historically, the stock market has shown long-term growth, and broad market ETFs, like those tracking major indexes, have often performed well over extended periods. Automation and reinvestment. Some investors utilize strategies like dollar-cost averaging, where they invest a fixed amount regularly. Additionally, many ETFs offer dividend reinvestment plans, automatically reinvesting dividends to purchase more shares, potentially accelerating growth over time. There are two types of ETFs, value ETFs versus growth ETFs. What's the difference? Companies held by growth ETFs are those whose revenues, earnings, or cash flows are forecast to increase at a faster rate than the market as a whole. Since they reinvest their profits into expansion, these companies are worth more but pay out less in dividends. Value exchange-traded funds, on the other hand, put their money into businesses that are selling for less than they're worth based on metrics like their financial statements, earnings, and assets. Established companies with a track record of dividend payments are common among value stocks. However, the higher potential returns of growth ETFs are offset by the higher level of risk they entail. while value exchange-traded funds, or ETFs, provide security and decrease risk. Their long-term growth rate is substantially lower. What to look for in an ETF? Reduced overall cost. Expense ratios for growth ETFs are the annualized costs of owning the fund as a portion of the initial investment. The yearly charge is usually deducted from your earnings once every 3 months. Expense ratios tend to be lower for larger funds. A proven record of achievement. Consider the fund's track record before putting money into it. You can tell if the management of an ETF has been able to sustain high returns over the long term by looking at its 5- and 10-year track records. Keep in mind that there is no assurance that your current success will continue. Advantageous variety. ETF's primary advantage is the high degree of diversification they offer. When picking a growth ETF, it's important to look at the fund's holdings to determine whether or not they are heavily weighted toward technology firms, reducing vulnerability through improved sector diversification. So, how do ETFs work to make you rich? For those looking to lower their investment risk, ETFs offer convenient diversification. Depending on the ETF, annual expense ratios might be anything from 0.03% to well over 1%. As a result, annual fees could cost anywhere from $30 to $1,000 or more for a $100,000 portfolio. Fees might vary significantly from one fund manager to the next, further complicating matters. One S&P 500 ETF from Vanguard has a 0.03% cost ratio. Invesco has an S&P 500 cost ratio of 1.29%. You should also be mindful of the fund's turnover rate, which indicates how often individual equities are bought and sold. Fees associated with purchasing and selling a property more frequently might add up. It's also important to know why an ETF exists and what it hopes to accomplish. For example, VOO is an S&P 500 fund that mimics the index performance. However, SH shorts the S&P 500, that is, bets against it, so you profit when the index falls. What's the best strategy to get rich with ETFs? The most effective way to build up wealth with an ETF is through a buy and hold approach. Trying to predict when the market will rise and fall rarely succeeds, and missing a big gain can be very expensive. JP Morgan conducted a study based on the idea that you would have missed out on the market's finest days. Your return was slashed in half because you missed the 10 best days. Think about the consequences of trying to time the market and ending up with $500,000 instead of $1 million in your portfolio. No one can predict when the stock market will have an excellent day. When investing in ETFs, how long does it take to save $1 million? Investing $10,000 annually at a return of 7% would allow you to save $1 million after 30 years. If you invest more money or discover a greater rate of return, you can reach $1 million sooner. To that end, one's ability to put away money and grow their income is measured by their savings rate. It's better to save $30,000 if you make $50,000 a year than $10,000 if you make $100,000 a year. Determine how long it will take you to get to $1 million by using an investment calculator. Put in the amount you can spare right now, the percentage of return you can accept, and how long you have to invest. For argument's sake, say you're 30 years old and have $70,000 in the bank. You've decided to put $25,000 annually into an S&P 500 index fund in the future. If you start investing now, you might have over $10.1 million in retirement. Let's say you're 30 years old and have saved $70,000. However, your annual investment limit is $10,000 instead of $25,000. When you retire at 65, your investments will have earned you only $5.4 million. The key to $1 million savings is time and effort. Value ETFs versus growth ETFs. Which should you buy? ETFs may be more attractive to investors seeking quick growth because of the possibility of bigger returns if the underlying assets produce above average returns. However, growth stocks are riskier because of their volatility. Value ETFs, on the other hand, tend to be more stable and reliable in terms of returns, though they may not offer quite the same upside as growth ETFs. Whether you should put your money into growth ETFs or value ETFs depends on your risk tolerance and financial objectives. To strike a balance between risk and reward, A well-balanced portfolio should have both growth and value funds. Before making any investing decisions, it's wise to do some homework and talk to a financial expert. So, in short, ETFs can make you rich. A buy and hold strategy with ETFs can lead to financial success. But before investing in an ETF, you should make sure you fully grasp its expenses and long-term objectives. If you find the video informative, like it and share it. Also, subscribe to the channel to keep up with new videos.